Home sales are collapsing and it's getting worse every single month that we're seeing. It's not the entire market collapsing, absolutely not. But what we're seeing in the Sun Belt is getting really, really bad. Let's dig into the data. And then if you have any questions at the end, I'll go through the chat and I'm happy to answer them. So the first thing is that we're noticing today is that the 10-year treasury rate is going crazy. Bonds are selling off. Jerome Powell is actually leaving his Fed chair. And I think there's a lot of concerns about inflation, and it's going to start adding up a lot into the housing market. It's likely by the end of today, we're going to see mortgage interest rates above 6.75, which is tremendously bad for the real estate market. So let me share my screen real quick and let's hop into the data of what we're seeing this week. Okay. And if you're in the chat, if you could just go ahead and make sure that you can see my screen and everything. All right. Awesome. Well, thanks for joining me. It's Friday, May 15th, and we're digging into the data. So right now we're seeing existing home sales just grind along the bottom. It's getting worse every single month. And we're actually at the great financial crisis level when you look at this number of existing home sales. Now, new home sales is a little bit different where we're seeing them, start to move up. Of course, we're in busy season, but this is because these builders are giving incentives, massive incentives, $200,000 off, buying down your interest rate to below 5%. They do this by forward commitments with the mortgage rates. They basically buy a tranche of, $10 million. They can use it for the next 12 months. And if they don't use it, they lose it. And they basically buy this. So they really need to sell their inventory, and they're starting to panic. And so that's why you're seeing existing home sales drop, because now these existing homes have to compete with the new construction. But the thing you need to take away from this is, first, you get a slowdown in transactions. It's exactly what we're seeing right now. And then prices are to follow. Now, I know a lot of people are saying, well, hey, there's 40% of homes that are already paid off, and we have, record amount of equity in homes. This is exactly what happened in the 2008 crisis as well. Everybody made those same arguments, but things can change very quickly. Real estate is a cyclical business, just like all businesses. They go through cycles. This is not going to get better anytime soon. And obviously, with the mortgage rates continuing to skyrocket today, we're all the way from below 6% now to 6.75%. Probably by the end of today, it's going to get so much worse. Every 1% increase in interest rates leads to 10% decrease in purchasing power. And consumers are already completely maxed out. And I'm going to go over that data as well. I want to have you understand how screwed the consumer actually is at this point in the market cycle, and how we're experiencing basically like a two-level economy where we have the hyper wealthy who are crushing it, own all the assets, and then the rest of the bottom 90% that are falling behind rapidly. Well, the problem is you can't have the bottom 90% not buy houses, because you're just not going to have the transactions. They can't afford it, and prices will eventually come down. The 10% of the wealthy in this country cannot support the entire economy, which from the housing perspective, from a consumption perspective, they're already the top 10% are already doing 50% of the consumption. So they already are dominating the consumption story, sadly at this point in the market cycle. But this is what I want you to understand. The forecasts that have come out for 2026 were so optimistic. More transactions, higher prices. You saw this from the National Association of Realtors, all these people who have a narrative and a reason to push this content on you so you go out and buy a house. They are financially incentivized to pump pieces out there so you buy a house. Now, what they're doing now is they're rolling back everything that they said at the beginning of the year, because they're not seeing it happen anymore. Zillow's forecast continues to get revised down. NAR is now revising down their forecasts. The pending home sales are often up at this time of year. They're actually up. There's a narrative that came out the other day, 10% up. Month over month. Month over month doesn't mean anything, right? We're going into busy season. It's year over year. I can tell you here in Northeast Florida, pending sales versus last year are down 34%. That's this little, let me just switch my screen here so you can see where I'm talking about. This is where I am right here in Jacksonville. But obviously the entire country, it's no longer just Florida and Texas that are getting hit. It's the entire country that is starting to see real estate turnover. Number one, because the math no longer makes sense. Number two, we had massive speculation that drove these prices to unsustainable levels, and we saw interest rates go up. So it is getting absolutely absurd out there for the numbers that we're seeing, the underwriting that we're seeing. And I'm not saying there's no deals to be had in the marketplace. There's absolutely distress in off-market deals that you can get and make the numbers work. I looked at one yesterday in Austin, Texas, where they're getting creamed. And it was a duplex. And I was like, wow, this deal, makes sense. You could buy, the duplex, each side rents for 1,400 and you can buy it for 300,000. That's almost 1% rule. And so there's still deals out there like that you can find, but it's off market, it's distressed, it's going to take work, it's a full-time job. And for most people, if you're a retail customer, that is not the same as what I'm talking about from an investor perspective. So I want to be clear on that. There's different aspects of which lens you're looking through as a consumer, an investor, a seller, a buyer, a renter. All of those have different lenses you need to look through. And that's why this channel exists, is so I can share with you what we're seeing. So look, here's where home prices are falling across the United States right now. You're even seeing areas of the Northeast start to fall. You're seeing, Washington is starting to really fall. Florida and Texas, obviously Florida is horrible. My market's actually ranked the worst large city in the country, for hottest markets. It's like the least hot market in the country. Austin, we even beat Austin, Texas. Austin, Texas was right behind us. But you're starting to see right now, even California is starting to get hit, which is crazy because you're seeing all these AI deals go through. People are using their stock options to buy real estate. So this is where we're starting to see the divide. We're seeing very, very luxury homes sell like hotcakes. You have a unique house, it's great condition, that's going to sell because there's so many wealthy people are getting massive payouts because of the AI boom. And then the majority of people who don't benefit from the AI boom are actually getting replaced by the AI. They're falling behind very, very rapidly. And so we're starting to see, the tale of kind of two markets go on here. But you can see that, again, it's not just Florida and Texas. This decline is starting to spread because that's like a lot of the critics are saying, oh, it'll never happen here. Of course it can happen there. It's a cycle. It may not be as dramatic as Florida and Texas and California and Washington and Colorado and all these areas in Arizona where there's just massive speculation, but it will eventually roll through. So this is what's happening. There's now two economies, right? So there's the top 10%. You can see this white line. This is the wage gap has widened. The top 10% wages continue to crush it, just doing fantastic, keeping up with inflation. The bottom 90%, whole different story. They are falling behind every single month. Cost of living for everything has just gone up, and their wages just have not kept up with what they're seeing. And this is what the major problem is. Prices of shelter costs skyrocketed way more than wages, and that made 90% of people fall behind. And that is the number one issue that we are seeing in the housing market. And it's going to get worse because of the policies that are being put out there. The majority of them only help a certain segment of age group and wealth group out there in the marketplace. And this is partly because the people who vote, the people who vote get the benefits. And that's, who get catered to because they continue to vote. So, I think at this point in the market cycle, I really encourage young people, if you want to have a voice, please get out there. We're always looking for people to support that represent the next generation. And I think that's a really important voice that is completely missing in politics today. And I hate to talk politics on the channel, but I feel that politics at this point in the market cycle is driving the entire market. Like, we're seeing institutional bans from the administration, which is a horrible, horrible policy. I can go into that if you have any questions about why that's horrible. I have prior videos on that. It doesn't even actually make sense. If you're going to do an institutional home buyer ban, it would have been like 4 or 5 years ago. They're actually net builders at this point and net sellers at this point in the market cycle. It's totally un-American and anti-competitive as well. It's completely away from the traditional values of Americans, but we're getting so far away from what we traditionally were as a country right now. It's not even looking the same. But that's not to be critical as the administration. I don't want to be critical of the administration. I want to be critical of the policy. I'm a policy person. I look at each policy individually. I don't care who came up with the policy. I want to understand what the policy will do for you as the consumer, so you can make the best decision for you and your family. That's what this channel is all about. But the top 10% and the bottom 90% function very differently, and the sales are reflecting this. This is why we're seeing record level luxury sales, and then everything else in the mid-tier level, like 300 to 500 to 700 is actually falling. So here's what we just another thing that came out. This is from Zero Hedge. Goldman flags troubling mortgage delinquency rise across the United States, and this is because the bottom 90% is loaded up with consumer debt to the point where they're just exploding at the brink. And mortgage delinquencies are moving up every single month because the workout programs changed last October. So during 2020 to October 2025, there's a 5-year period where basically there were zero foreclosures, but that stress each year, though, 0.5 to 1% of properties that fell behind, they're all coming due at the same time. So we're going to see a massive foreclosure and short sale spike going into the end of the year. And it's even worse because these are the people who are loaded up with debt in the first place. These are people buying with FHA loans. By the way, if you didn't know this, FHA loan delinquency already right now, 13%. 13% delinquent. That is massive. And we're not everything's at all-time highs. This is at a time where everything's at all-time highs. This is why we call it an affordability crisis, right? This isn't a housing crisis. This is an affordability crisis that is rolling over into housing because people are falling behind. And that's why more distress will come. Well, let's look at it from, every single angle here of consumer stress. There's a lot of pent-up distress across the system. Credit card delinquencies, also 13%. Student loan delinquencies, obviously, people didn't have to pay for a while. It's very bad policy. Now people just don't want to pay it all. They want it forgiven. I don't know what your political thoughts are on that. I believe in self-accountability. I know the first thing I did coming out of college is I spent the next 3 years grinding my butt off to pay off all of my student loans. And that was the first thing I did because I didn't want to be caught in the debt trap. I didn't go out there and buy the new car, buy all this new stuff. The first thing I did was just attack my debt aggressively. And I think that there's, a lot of people that got degrees that they can't even make the money, honestly, to be able to pay off their student loans. Auto loans, you're seeing them start to skyrocket. You're seeing record high repossessions out there in the marketplace right now. And even though mortgage delinquencies are very low, it started because of the workout programs that happened over these years. That's why it's so low. Okay, this is misleading. People keep saying, "Oh, well, the mortgage delinquency is not that bad." No. The delinquency was that they were just doing a workout program and putting their payment on the back end of the loan so it doesn't look like it's 90 days delinquent. Now that stuff is going to start showing up. So you're going to see a report basically every single month in the news saying, delinquency is moving up, and it's going to be absolutely crazy. Now, the credit card situation is bad. Obviously, if you don't pay your credit card bills, you're going to get hit on your credit. If you don't have good credit, you can't go out there and buy a house, right? So this is why this is very important for housing, because we live in a payment economy. What that means is everything is financed. People, the consumer generally, not the top 10%, they live in a cash world. The 90%, they basically finance everything and they max out their max possible payments. So what happens when they're completely maxed out and their debt to income ratios are too high? Well, they can't buy a house. If they don't pay their credit card, they can't buy a house because their credit gets hit. And we're already seeing credit card delinquencies, 90 days delinquent, 13.1%. You can see that's competing with the great financial crisis levels of defaults already. And the crazy thing is our unemployment rate is fantastic, but there's record level of layoff announcements last year, record ever for the number of layoffs. And I don't care what anybody says about AI. If you use AI, you use Claude, you use GPT, the power of AI is unbelievable. 80% of white collar jobs will absolutely be removed by AI over the next couple of years. The people who really know how to use it, they're going to make a fortune. And then the people who don't use it, they're going to get left behind. I believe that the unemployment rate is going to skyrocket over the next few years because of this. And you're seeing this across the board. You're seeing the Mag 7 stocks just completely eliminate jobs every single month. You'll see the same company reduce another 3,000, reduce another 3,000. They're replacing them with AI, with really intelligent people that know how to use AI that can do work of 100 people with one person. And they're paying that one person that they keep, the same amount of money. And so the corporate profits are skyrocketing. You look at the stock market right now, it's skyrocketing. Why? Because corporate profits are skyrocketing. Why? Because they're using AI in their business to basically cut people. They don't need as many people anymore to do the work because the AI is doing the work. So their margins will continue to move up. And I truly believe that'll be the case. So we're going to have, again, even more of a divide than what we have right now between the rich and the poor. And this is going to create a crisis situation for the American people in the next few years. And it's going to dramatically impact real estate and how we think about real estate as investors. And it's something that you need to be thinking about right now. So here's the credit cards outstanding 2008 to present, we're at 2008 levels, right? So at the same time, we're seeing assets have inflate rapidly. So it's really crazy to see people have so much debt while assets are so high. It's because that debt is carried by the bottom 90%. Okay. So it's not fairly distributed. And the other thing that's a little bit scary is that the savings rate is grinding along the bottom as well and kind of going lower. So the consumer is maxed out, they're spending maximum on credit cards, and then they're saving basically nothing, and it's going negative. And so that is a red flag that we're at the end of the market cycle from the consumer perspective. And GDP is 70%, around 70% consumer spending, but the top 10% is 50% of that consumer spending. So the lower class, like the lower income folks, are becoming less and less important to the economy because they never were contributing that much or consuming that much anyway. But they're getting left behind. And this is where I fear that the politicians are not taking the situation seriously. And we need to think about society, like as a society, how we're going to handle the changes that are coming down the pipeline, and then how that's going to impact real estate and real estate prices moving forward. Because obviously if people can't buy houses, these prices will come down, I think, a lot. And if we start building robots that build houses, we have these prefab houses, I think that prices could come down a lot too. You think about how self-driving is going to change where you need to live to work, or everybody's going to be working from home, for example. Why do you need to buy a really expensive place in the city when you could live outside the city in like a prefab home or a pre-built home that is, like worth 50% less, and it's still a great house. So I start to think about these things as an investor for 30 years from now. I think things are really, really going to change the landscape because of the technology shifts that are coming through. These are insane technology shifts. I think AI is more important than the internet, more important than the railroads, more important than all of these massive breakthroughs that we have, because it makes things go really quick. And then the next breakthrough will be robotics as well. And so everybody's going to be on the lookout for that. And I think that'll also get rid of a lot of blue collar jobs. But here's what we're seeing. This is why we're saying K-shaped economy. Look at this chart. The United States Consumer Confidence Index is at all-time lows. All-time lows. It's never been worse. The consumer has never felt worse. We're seeing inflation move up. I know the PPI came out 6% the other day, which is crazy. We've been above the 2% target for inflation for the last 3 to 4 years, and the financial distress is spreading. You can see people looking for, what is this? It says interest over time, right? Of this search, credit card, pay credit card, right? So people are having issues getting things paid off. And I think this financial distress is spreading, and it will continue to spread and get worse as things go on. And I could totally see the stock market keep going because those corporate profits keep moving up while the workers, so Main Street basically versus Wall Street, they get completely disconnected, but they can be disconnected because the profits are true for the company and the situation for the consumer is bad, but the top 10%, they're going to continue to consume and become more of the consumption of the United States over time. And that's going to impact the housing market because everybody needs a place to live, but we already have so many homes in the Sun Belt. We're overbuilt in the wrong price points. And then we're underbuilt at the entry price points and the workforce price points because of the incentives that builders have, on their margins, right? They don't want to build a house and only make $40,000 when they could build a house that's twice the size, 2 times more expensive, and make 7x what they would make that other house. So here's a report that came out. It's home buying intentions of U.S. adults who don't own a home. It's dropped to the lowest level, right? Only 25% of U.S. renters expect to buy a home in the next 5 years. This is the lowest ever recorded. In 2013, this was 57%. So the consumer's not even thinking about buying a house at this point in the market cycle because the buyer can no longer support the current pricing. In a lot of cases, you can rent that same exact house that you're going to buy for much less. And what I mean by that is, like, you could buy the house and have a monthly payment of $2,800, or you could rent that same house and pay $1,800. Why would you pay an extra $1,000 a month to buy? In most cases, it doesn't make any sense. You also have to pay the transaction cost to get in and out of the transactions. They're out 10% round trip. And the problem is, when I bought my first house back in 2014, it was a starter home at $180,000, and it was cheaper for me to own the house than it was to rent an apartment downtown. It's completely flip-flopped. Now it's just way more expensive to be able to purchase. That exact $180,000 house is now 450,000, and the wages haven't doubled or tripled, So it's one of these things where the math is broken, and it's the only way for it to fix is for prices to come down. And unfortunately, right now, interest rates are going the wrong way. So because interest rates are going the wrong way, I think that prices will actually come down more. So if we see, the 10-year treasury crack upwards another 20 bips from here, we crack 7% on mortgage interest rates, I think we're going to see a massive stall in the market. And so we'll have to see what the Fed does, because honestly, there's now people calling for the Fed to actually hike rates versus cut rates. So we'll have to see what happens with the new Fed chair coming in. The Fed chair matters for sure, but there's 12 voting members on the FOMC, so they don't have complete control, and there is dissent. So it's something you need to be thinking about across the board. And look, the people on the other side of this argument will say, well, that starter home was 180,000, and the new houses, they have an extra 500 square feet associated with them. Yeah, they might have an extra 500 square feet, but you and I both know that those builds suck. Those new builds are horrible. They have zero lot lines. They have zero backyard. So even though, yes, it might have more square footage, the build is bad, and you're getting less acreage. You're getting packed in there with somebody else. So I would kind of argue the opposite side. Like, it's not that much better than what these previous starter homes were. Yes, it's new. It's going to need less maintenance and repair, but you're not going to get the yardage and stuff that people want and enjoy about actually owning a home long term. And so here's the ultimate disconnect, right? You need to make that, or the income needed to buy a house over the last 6 years increased 79%, but wages didn't go up 79%. It went up about 30%, and productivity didn't go up 79%. So ultimately what happened was the American dream got 79% more expensive, the American dream of owning a home. And it's not really owning a home at this point. It's being in debt, long-term debt, and then you eventually own a home over 30 years. But most people don't stay in their house 30 years. They only stay in their house 10 years. And most of in 10 years, 75% of your payments will be interest that goes to the bank, and the bank will make a huge amount of profit on it when you go to flip that house or sell it or do a mortgage payoff. But this is what's happening. The math stopped working for the buyers, and so sellers are stuck, and the listings are starting to stack up across the board. And so just let this sink in. This chart is very important. Household income needed to afford a finance purchase of a typical valued home, $93,000. Well, in Jacksonville, Florida, our median household income is $68,000, right? So that's already getting rid of the majority of people. They simply just can't even afford to buy a house at today's rates and today's prices, and rates are moving up. So prices really have to come down. And I think this chart's really helpful. So it shows that, where Americans are and how priced out of homes they are. Across the United States, 65% of people are just unable to buy a house today. And in Florida, it's even higher. It's 71% of Floridians can't buy a new home at today's prices and mortgage rates. This comes from Visual Capitalist. I like this chart. It just gives you an idea of like how bad things are. But the builders will continue to build their starter homes at 500,000 with practically zero lot lines. They're incentivized by local governments to build. They get grants, rev grants. People want to see the luxury product. They want to get as much tax revenue as possible. And I get it. It's a big political game to get these developments across the board. But honestly, at this point, we're overbuilt. We're flooding the market with this mid-level luxury stuff. And who do they think is going to buy these? In Florida, what we're seeing is actual migration pattern changes where people aren't relocating to Florida as much anymore. They're actually choosing to go out to the Midwest because that's where the construction boom is happening. And that's where things are cheaper right now. And I think that is going to be the next story is migration pattern changes because there's just zero affordability. There's not as many jobs in Florida that are high paying to be able to keep up with these high costs. And I think over time prices will correct if the government lets it, right? And they don't step in and try to change everything. But, the government tends to just try to fix things. And then when they try to fix things, something pops up somewhere else that causes a problem. And that's something that, there's these politicians are all way too short-term thinking. They're all looking at votes versus doing what's right long-term. And I think that's a huge problem that we're seeing play out here, right? Everyone's in there for the instant grift, the instant money, and they're not making decisions that'll help people long-term. And I think that's a very short-sighted approach that's going to cost us down the line. And so here's the chart I was talking about earlier, why the housing market is frozen, right? The payment to buy, if you're going to buy today, it's $2,800 roughly, and you're renting the same house for, $1,900. So you could save that money. The other aspect is on monthly rents are falling. Here in Jacksonville, rents are down 15 to 20%. There's more accidental landlords, people who go to sell their house, they can't sell. They turn it into a rental house. And then we have this glut of supply of all these rental houses. And then they sit vacant for 90 to 120 days. The landlord gets upset, fires their agent, try to do it themselves, fails, puts it back on the market at a lower price. They're chasing the market down. And so we see this all the time, every day. By the way, I'm an operator here in Jacksonville. If you need a top agent in your market, let me know. I talk to all the agents across the country, and I'm always, worried that you're going to get stuck with one of those bottom 80% of real estate agents that are part-time, don't produce, aren't looking out for your interest. If you want the best of the best, that's going to give you the best bang for your buck, reach out to me. I can get you in touch with somebody who will actually tell you the truth about your individual market. I'll drop my email in the chat so you can reach out to me, and I respond to every single email. I love connecting with all of you. I get like 2 to 3 emails per day from people who watch the channel, and I love that. If you want to run your situation by me, you don't need to pay me or anything. Like, I'm just happy to help. I want to see you guys win and hear what you're seeing on the ground, the stuff that you're structuring, what you're either struggling with, or things that you're actually seeing as an opportunity. I learn from you guys as much as you guys come to the channel to learn from these charts and graphs. So look, ultimately what's happening is the landlords are getting realistic. They're dropping the price of the rentals. They're dropping the price of their house, and this trend can continue down over years. I don't think this is going to be something that's going to happen within 1 year. That's not really how real estate works. It's an illiquid asset class. It takes time for all of this to play out. So this will take time, absolutely, to play out. Now, this has caused inventory. This affordability crisis has caused inventory to jump to pre-2020 levels. And this is, again, the critics always say, well, it's not that bad. There's record equity. It's just Florida and Texas. No, it's not just Florida and Texas. There's 14 states now that are above 2019 levels of inventory, and it's moving up. Now, obviously, the Northeast is very different. They didn't have that construction boom that we had. Here in the Sunbelt areas, they didn't have the multifamily boom. They didn't have the single family boom. It's very much harder to build there. It takes longer. It's more expensive. But the key thing here I want you to know is that it's no longer just Florida and Texas. Look at what's happening in Colorado, in Washington State. These are also speculative markets, but they were hot just a year ago and doing fairly well. But you can see, obviously, Florida and Texas. There's an interesting phenomenon in Florida where, again, there's so many accidental landlords. There's not as many new listings coming on. People are just staying in their houses, and the number of transactions are really slowing down. And so you're not seeing as many new active listings coming up, but you're also seeing like this massive shadow inventory from the builders not be listed. They say they have like 500 lots for sale, and they're just not listing the 500 lots, right? They're listing 2 houses, 2 models on MLS. It's only capturing 2, but they really have 500. There's so much more inventory in the shadow inventory than you could possibly imagine. And this happens across the board, and they're covering it up. I even went down to an area outside Tampa called Lakewood Ranch, where they're just building these mega mansions in the middle of nowhere, 0 lot lines, 2,000 to 2,500 square feet, and there's no jobs. There's nothing there. It's just in the middle of nowhere. It's not even near the water. And it's just, they keep building these houses and they're like faking it. Like, there's like workers, they're told to park in the front of the community. They're pulling out the trash cans to make it seem like people are there. And people fly down and they look at the community. They like the build and all this other stuff. They have no idea what's happening in the local market. And that's, again, why you need to reach out to me. I can get you in touch with a top agent who will tell you what's actually happening in that specific market. Now, here's what's happening to the builders, because they're freaking out, right? And they really are freaking out. You can see this in the margins across the board. And what's not captured also is the amount of incentives that are given. And this isn't captured in the median sale price, right? The amount of incentives that are being given up by sellers, including builders, right? Sellers are fixing every repair in their house. They're upgrading their house. They're giving closing cost assistance. All of that is not captured in these median home price sales, but it is captured because there's public filings on these public builders. So this is what happened with Lennar. Lennar is already, with net of incentives, down 24% from the peak. Look at this. In Lennar, you were buying a house at $491, and then net of incentives today, you're down to $374. So if you bought at that point in time, you are completely underwater in your house. And so if the market was actually as strong as these other people who are, the shortage narrative people are saying, then builders wouldn't be buying down their interest rates 30 to 50K. They do that because they don't want to reduce the price of properties in the community at all. They'll do anything to not have the price of the property, including they own their own mortgage company, by the way. And so these builders own their own mortgage company. They have control over their own appraiser panels, and they can decide who appraises the houses basically in their own community. And you wonder why the appraisal always comes in at exactly the price. It's because they all know each other. All these people generally know each other. I don't think it's as independent as, people might think, because you get to pick your appraisal panel and they're all owned by the same company. So I think this is a really interesting thing. Have you ever seen a new build, if you use the builder's lender, have an appraisal come in low? Okay. I want to ask you that question. Have you ever seen that happen? Because I rarely ever see it. And if it did come in low, I guarantee you, at least I would think, that builder would then kick that person off of the panel to do the appraisals on their listing inventory. And they wouldn't get any more work from that builder if that was the case. And this is how the builders are trying to keep their prices as high as possible for as long as possible to make a sales for at this point in the market cycle, and push that risk from them to you at the peak of these prices. And of course, what we're seeing right now is the housing demand is just grinding along the bottom, right? So at the beginning, I showed you that existing home sales are grinding along the bottom, but demand is continuing to grind along the bottom. Inventory is going higher. There's falling pending sales. And this is a dangerous situation, because we see a massive number of homes that fall through because these homes are 30, 40 years old. They need, tons of upgrades. The next generation trying to come in, they're trying to buy. There's like two types of people that come in to buy right now, right? There's the dual working income families that we see a lot of the times, and they're just like rubbing nickels together. They have like two kids. They barely have 2 cents to their name, and they just buy themselves. And that's like the bottom 90% of folks. And then you have like these rich kids that are going in to buy houses. They're getting the down payments from their parents. They just buy whatever they want. And so we're seeing, just like two different types of economies that's happening here. And there's just the people that don't qualify. And a lot of these people, they do their mortgage application, they see what the monthly payment's going to be, and then they just like, nah, I'm going to rent. So that's why you see actually mortgage applications kind of go up, and they see the price of what the payment's going to be. And they're like, why would I buy for $3,200 when I could rent the same house for $2,200? I'm just going to keep renting. And that's honestly what we're seeing, happen a lot. But pending home sales have been collapsing. Housing demand is tanked. And the Midwest is the one, again, people are going to the Midwest because of affordability, because of the AI boom, the tech spending, all that stuff. But the South is not doing well currently. And it's starting to, even though it's busy season, it's not as hot as people would think. There's obviously pockets of every area that does well, depending on the unique factors of that area. Like even Jacksonville is 5 cities in one. So I want to be clear on that. Not every segment of Jacksonville is falling. There's certain areas that are actually still holding up or moving up. But the areas that are the most concerning are the areas that are built around new construction, in the suburbs, outside the city. And that's really where we're seeing the majority of the pain is around the new construction or existing homes around the new construction, because there's just too much inventory at those price points. So here's again, how can we have a housing shortage when we have 46.3% more home sellers than buyers in February 2026? This is the biggest difference that we've seen since Redfin started looking at this data in 2013. So I think that, the buyer demand is going to continue to slide down. The sellers will continue to list, and that'll continue to move up, especially going into the end of the year. When you have to understand, once August and school starts, demand drops 30-40% going into the end of the year. And that's when we're really going to see the number of price cuts accelerate. We're going to start seeing the listings accelerate. We're going to see the short sales and foreclosures start to accelerate, because the workout program ended October last year. A lot of these states are judicial. It means that the foreclosures have to go through the court system. It can take a year plus for people to process them. So this is all going to come through, I think, by the end of the year, especially if we see interest rates continue to creep up like what we saw happen today, which I think is my next chart. Perfect. Okay. Interest rates just cracked 4.5% on the 10-year treasury. I quote the 10-year treasury because most people stay in their house for 10 years. 10-year treasuries tied to mortgage, because mortgages durations 10 years, right? So again, mortgage rates by the end of today will be above 6.5%, maybe 6.75%, depending on how it ends up. But this is a major red flag for what's happening in the bond market. And the bond market's basically screaming, right? Just a few months ago, we were below 6%. And we were just saying like, oh yeah, demand is great. We're going to have a great year. Things have dramatically changed in just 0.75% in interest rates, because the affordability, because we're in an affordability crisis, makes people so much on the fringe. They just opt out. And I think that's the issue is, it's not a sign of a good economy if people are so interest rate sensitive. It's not because they're winning. It's because they're focused on the numbers, which they should be. So look, I'm going to go through and answer all the questions in the chat. I'm going to hang around here for another 10 minutes. Love to connect with you. Happy Friday, by the way. Hope you're going to have an awesome weekend. I'd love to hear two things from you. Number one, if you need help on anything that I talked about here today, you have any questions, reach out to me. I respond to every email. Sometimes it takes 24 hours, but I get back to mostly everybody pretty quickly. And I want to hear what you're seeing on the ground, right? Disagree with me. Tell me, other facts that you're looking at. Let's have a conversation about it. That makes us sharper on both ends. I'm not somebody who's politically one direction. I feel like I have no political home, to be honest with you. I feel like I'm seeing stuff on the ground because I have, I do 1,700 transactions in Northeast Florida. I'm friends with top agents across the country, top investors who own multifamily across the country. I talk to all these people all week long, and I hear all the stories of what's going on, the fraud, the extensions on the loans, hey, I'm underwater on my house. I get all the calls from the short sale people. Hey, I'm trying to process foreclosures. I get all of this information. I'm sharing it with you because this is what I see happening, and I don't see other people talking about this. And that's why I started the channel in the first place. And I see what the media is saying. Oh, there's a shortage. We have all the shortage of inventory. We're going to ban institutions. We're going to do 50 or more. I see all this crap. That's horrible. And I need to share I feel like I need to share the other side of the story so you get the complete picture versus just buying what the mainstream media is pushing on you, because you have to understand the level of manipulation that they will go through to try to make a story stick. And not to get political, but we're seeing that stuff with Thomas Massey, right, in Kentucky. Like there's a political machine, there's a media machine that is trying to convince you that we have a housing shortage. Okay. That's just not real. Okay. And then they're banning institutions. That's just not real. That's not even happening anymore. They're not even buying. They're net sellers. They're net builders. They're building build to rent product in 200 homes down the street where it's reducing rents for the entire community. I want them to keep building because that'll bring rents down. Right. So I think people are totally confused about how these products work. And I know how to do this because I used to work at an investment bank, and I used to work with American Homes for Rent, Progress Homes, Invitation, like all these big players, First Key, and they provide capital. They rehab the product. Sure, some of their service sucks, right? They're sucky landlords. It's very hard to be a aggregate landlord. They gouge you on prices. They charge you on fees. Totally, 100% agree. Who else is going to go in there and renovate hundreds and hundreds of houses per month, get them up to speed, and create that rental inventory that we badly need that was previously just going to be a distressed flip? It was going to happen anyway. They just institutionalized it. But the minute the math changed, they stopped doing it. They stopped doing it in 2022. They stopped buying, and then they became net sellers. They've been trimming their portfolios, and they've been focused on build to rent because they realized that they can get higher margins and build to rent. Good. Let them do it. Let them build this inventory. It's really important. So with that, I'm going to stop the screen share. I'm going to go through and answer any questions that you have. Thanks for hanging out. If you want to learn more, you can subscribe to my Substack. It's johnbrooks.substack.com. You can follow me on X. I put my posts there. If you need help with real estate, let me know. If you need connection with a top real estate in your area, let me know. Buy, sell, whatever you need, even rent. I'm happy to put you in touch with people that I can. Give me a like and a comment on this. It really helps the channel and motivates me to continue going. I've been so excited to have, nearly 15,000 subscribers to this channel, and, just within less than a year. So I appreciate you all following and listening and communicating, right? I learned so much from you guys by you being here. So with that, I'm going to open it up to questions in the chat. So let's see here. I'm just going to take a drink. And if you got value out of this too, let me know. Like, hey, I didn't know that, and I'm glad that I learned that. Just signed a 3.3K lease for a nice house. Plan on renting another 12 to 24 months. It's too expensive. Mittens, where are you at? Let's hear where you're at. Not paying $247 for a 46-year-old single wide. Yeah, the single wides here in Jacksonville, people buy lots. They put a single wide or double wide on it, and they sell it for like $300, $350. It's kind of nuts on the prices there, and they sell. They actually sell because there's just nothing at that price point available. So what else are you going to do? You're just going to have to rent. Someone tells sellers rates went up and they need to lower their prices proportionate. Yeah, one of the things we do as sellers too, Jake, is we just do the math for them. We show them what the payment would be buying it today with 10% down, 3% down, and then ask them, would you buy it at today's rate at this price? And ask them themselves. Most of them are just like, no, I wouldn't do that. And you're like, yeah, that's the problem. That's why you need to be realistic. When the buyer comes in, you need to make the house beautiful, perfect condition, everything to make it really easy for that buyer to accept the house. Pending sales up, see if closed. That might work. Southwest Florida, particularly Naples, are up year over year. Yeah, why Naples, right? because of the K-shaped economy. Naples is extremely wealthy. They're having massive number of sales. We're seeing this in areas that have massive amount of wealth. When they own stock portfolios and their stock portfolio goes up 1% every single day for the last 30 days, of course, they're going to go out there and buy real estate, right? They want to diversify. They're excited. They have all this money. The money is flowing. There's more money flowing around everywhere right now than basically ever before, and so that's going to be one of the cases. But you look at the regular houses, like the $500 to $700,000 houses, they're having a harder time selling because they don't have the money to be able, like the average person doesn't have the money to buy those. This recession is going to rival the 1980-82 double dip one. I think we're headed into something. I don't know what it is, but I can tell you if the bond market cracks, we could see drastic change in what's happening in the market very quickly. That's the one thing I think, Ray Dalio has been talking about. A lot of these people have been talking about is we're so in debt as a country from the consumer perspective, and just the US government continues to spend with zero accountability, $2 trillion added to the deficit. We're just loading up with debt. And that's a tax on the consumer, right? When the government prints all this money and increases the money supply, it makes your dollar worth a lot less. That's basically the version of a tax. So you're getting taxed whether you know it or not. And that's going to ruin the middle class and the low income earners. And the rich people, they just continue to get rich. And look, I'm wealthy, I'm independently wealthy, but I didn't come from much. Lower middle class is what my parents would probably tell me. But I earned it. I got assets. I bought as many assets as possible in the shortest period of time. And I'm a beneficiary from the rising market. But I can tell you that none of my friends have any money. They're living paycheck to paycheck, and they're in their mid 30s, and they're falling behind, and they're choosing not to have kids. It's getting worse. And so, that's another thing that we talk about is the demographics are getting worse every year, where people are having less kids. They're not getting married. All of these factors, they're not starting families. They're not settling down. It's a very dynamic type of economy where I think this stuff will play out in housing over the next 10 to 15 years. Who buys all these products that companies make when the high farmer jobs are eliminated by AI? I don't know who. Yeah, I think that companies will just sell back and forth to each other, and they'll consolidate power. And so we'll see how it plays out, though. I'm optimistic. I believe in the United States. I believe in the American people. We need to vote better. We need better options for candidates for president and for Congress. We need to pick better. We need to be more educated. And that's where I'm concerned is people don't spend the time to actually think for themselves. They're just like sheeple. They just believe whatever is told to them on whatever news source that they listen to. And both sides, they try to manipulate you like crazy. And so where can you get like actual information to help you make an informed decision with people that you can trust? It's really hard in this type of world to be able to identify where to go from here. So my Not Me by Connecticut 600 square foot house goes for $2,000 a month rent. That's awful. Note, my house note is 1,900 for a 1,900 square foot, 1.5 acres. So thanks for sharing. Almost everything bubble is about to pop. Well, the thing about bubbles is that they can last a long time, T. Chris. You think it's about to pop and it could last another 5 years. That's the problem with trying to be short the market or short anything. And then when there are bubbles and they pop, the government just steps in and bails everybody out. So all these speculative losses are just going to get bailed out by our tax dollars. And that's the sad part. There's no accountability. There's just going to be crazy speculation, crazy fraud. Everyone's going to get bailed out. And then the consumer, the middle class has to pay for it. So I think I don't know if it's going to pop. There could be a pop, but I just like the corporate profits are going up, Chris. Like, look at the corporate profits. I think that's the one thing that most people are missing. And maybe the Fed raises rates and that kind of pops it. So we'll have to see. I think most of what happens in the economy is really driven by what the Fed decides to do with interest rates. But we also have this technology boom that's coming through that's changing the entire world in the next 1 to 2 years. It's changing it right now with all these layoffs. So I think we're kind of looking at different dynamics here. Problem in my state is early 2000 starter homes were bought up and turned into gigantic houses. There's not many starter homes left. Money was cheap to borrow. I wired money. Yeah. That's absolutely true. That happened across the United States. Just that's the issue of the zero interest rate policy. Sounds like a chill place to live, empty neighborhood. Is a good time to buy a little cheap rundown house for 100,000. Constructive criticism. It's up to you. If you want to do that, you just need to do the math. And it all comes down to opportunity costs, where you live, how long you're going to be there, what can it rent for. all the different things. So it creates optionality for you. And that's why you need a top agent in your market to run those options for you, so you can make the best decision for you and your family. So that's just like a broad question. I don't know, because I don't know your situation. It depends on your situation and your local market conditions. May not be the same topic, but can you say this buyer's market send offers at least 10% lower and ask for concession is a little bit too much? Uh, I don't know how to say your name, but yes, you can definitely lowball. Though I would say this: don't lowball on every house, because if your real estate, like, it's got to be on the market 90 days, usually 60, 90 days, and they have to be desperate, couple of price drops, and all that stuff before people are really going to talk to you. If it's listed on the market for 2 days and you send that stuff in, people aren't going to reply to you. Your agent's also not going to like you, because they want to have a good relationship in the community, and them just like sending out tons of lowball offers. Nobody wants to work with those people. They want to be realistic. So if you're going to get a lower price, it needs to be something that's off market and, in distress of some sort, like, right, death, divorce, disease type of situation that like wholesalers get, right? So that's one of the things I would say. If it's a retail market, it's just new on market. No, usually the negotiation is not going to happen as quick. Just like if you were a seller, you're like, dude, it's day one. Why would I take 10% off? But if it's day 100 and they're desperate, then they might take it. So you need to read the room, basically. Tallahassee seems like prices were dropping in February, but have pumped up again. Yeah. So here's the thing about Tallahassee. It is a different market, but keep in mind it's busy season. So once busy season starts, it's usually mid-February. You're going to see a pump in basically every single market. If you want to buy, the best time to buy is usually October and November. That's when there's the least number of buyers, people on vacation, there's tons of inventory, and this is busy season, right? And there's also a difference too. There's the 90% of houses that aren't completely up to date, aren't unique properties, and they don't sell. They just sit. But if you have a perfect priced home that's in great condition, it's going to sell like a hotcake. Buyers want the perfect condition house. They don't want to have to throw a ton of money in there. The longer Hormuz stays closed, the worse this is going to get. Yeah, I mean, the rates jumping is really bad. 30-year bond at 5% is really bad. Yep, absolutely. You own nothing and be happy. I don't know if that's intentional or not. I understand the concept behind it. We're probably the bottom 80% won't own very much, and that's why we're probably going to have this kind of like socialist movement. And I think it's horrible. It's like much worse than like I'm very much a capitalist. But like, what do you do when AI replaces 80% of white collar jobs, and then robotics replaces blue collar jobs? I don't know. I don't have the answers for that, but it's something that we all need to discuss as a society and start thinking about how we're going to play these next 10 years together. So it's something that we definitely need to look at. Treasury market is about to crack due to stagflation. I agree. We're speeding into a slick turn in the road ahead. If rates keep moving up, real estate will get crushed. Okay, so if we see another few days like this, I've already getting text messages from lenders across Florida this morning being like, oh no, like, oh my gosh, this is so bad. They're like, I can't even look at this. I'm going to the beach. I'm not even gonna look at the market today, because their whole business model is based on mortgage rates. If rates go up, the buyers are so price sensitive, they just walk from the deal. Forget drilling well, struggle with FEMA. Colorado Springs has many houses just sitting on the market. There's been price cuts, but housing is still high. Yes, because real estate takes so long to adjust. All right. It's a liquid. Takes sellers, 8 to 10 months to get realistic on what the price actually should be. So I think that's important to understand. Like, this is not something that's going to happen overnight. I actually, my prediction for Florida is it's going to take 10 years. Like, this is going to be 10 years structural decline across the board. So if you're buying investment property here under 400K, would you make moves yet? Depends on the investment property, depends on underwriting. I'm actually going to create an underwriting tool and put it on my website so you guys can underwrite your properties the way that I look at it, because I used to build these out for investment banking. I was a real estate financial engineer, believe it or not. That's actually a term that, I would basically take all the loans backing all these rental properties, send it, go work on Wall Street, tranche them out, and then sell them, package them, and sell them internationally. So that's what I used to do. And I think it was a great learning experience. And so I have the investment analysis to be able to, give you guys the models and tools so you can run the numbers for yourself. And everybody has different numbers. That's the other problem too. Like, you might see, well, I'm more of a speculative person. I'm more about price appreciation. I'm more about cash flow. I'm more about flipping. I want to make a quick buck. Like, every single lens and every time frame is so unique, and each market's so unique. I think it's important to look at that. I'm happier the lower my home goes in value, it puts money in my pocket. I think, prices will come down across the board anyway. And I think that's great for the next generation. We need a reset to let the next generation have a chance to get into this market. They think 250K for a garbage deal is garbage is a deal. Florida screwed long term due to climate change. I think there's climate issues for sure. I'm more concerned about the demographic shift because 22% of Florida is, baby boomer and older, and sadly the majority of them will pass away in the next 20 years, and they own a lot of real estate, and I think all that real estate will come to the market, and you have to ask yourself who's going to replace all those people living in those houses. And I think that's something that we're going to see play out here in the next 10 to 20 years. Either prices go back to 2019 levels or they keep the overpriced money pits. So in Austin, Texas, we're starting to see stuff go all the way back to 2016 levels already. Okay, that's what I'm hearing the word on the street is. So, I definitely think we could go back to 2020 levels. There's going to be a backstop at a certain point where it'll make more sense to buy and hold it as a rental. We just don't know when or how that'll be. It depends a lot on where interest rates fall at too when this all settles out. But it could take a long time for all this pain to settle through the economy. So yeah, the Midwest is holding value. They didn't overbuild. They're more affordable. And there's a lot of construction going on out there. So I think there's a lot of opportunity. Southern California, I don't know enough about it, but if you need an agent in Southern California, I have friends out there. So just send me an email. Happy to connect you. 10 years seems like a lot of time for inflation, national debt to balloon, which would increase the value of assets like houses. So there's a difference between supply side inflation and demand inflation. So we're seeing, basically supply side inflation because we're seeing, oil prices skyrocket. And that's a different type of inflation that's actually bad for real estate. So I look up those two different terms, digital dopamine. I think I was thinking that way too, but it's just like, it's not the right type of inflation that we would see. Of course, the money supply expanding, sure. But if you can get a 10-year treasury for 5%, but you have a cap rate of like 5% or less on real estate, there's no reason to buy real estate when you can get the risk-free rate for 5%. So it's all about asset class allocation. What is the returns? What's the opportunity cost they can get in other assets? That's the way that I look at it. Lower property taxes will crush the government scams. So we'll wait till DeSantis comes out with his Florida property tax proposal, and then I will break that down on one of these calls and let you know what I think about it. It just depends on totally what the terms are in the deal. And so we need to look at that. The Fed can't stop it. So my prediction with what's happening with they'll continue to print, they'll continue to be more inflation, we'll continue to see higher rates, and I think that'll crush real estate. And that's my prediction of what will happen. But again, it can change on a dime. It just depends on what happens, right? If the Iran war ends, in a week, the Hormuz Strait opens and oil starts flowing through, we get oil back to 60, 65, something like that. Then the Fed steps in and cuts rates. We could see a little boom, right? We don't know. So, that's why I create this channel. And I just let you know, here's what I see happening right now. And this is what we're seeing on the ground. So I'm not, it's really hard to predict these things. It's really hard to say where things are going to go because it's impossible. Nobody really knows. But we do know fundamentals. We're overpriced and the demographics are bad and migration patterns are shifting. And I think those factors will continue to be true and make it challenging for real estate. As always, guys, thank you for watching. Appreciate you. Have an awesome weekend with your family. I post a video on Tuesday. That's a pre-recorded video. And then I do come here and do the Q&A with everybody on Fridays. Thank you so much for supporting the channel. If you want to follow me on X, I'm at John Brooks, Jon Brooks. If you want to follow my Substack, it's johnbrooks.substack.com. If you want to reach out with a question, you have a real estate, you need help with anything real estate across the country in the United States. We're in Florida and Georgia. We do about $600 million a year in transactions. We have top agents at our company here in Northeast Florida and Georgia. So if you need help with any of that, we got the best people, absolutely, hands down. And by the way, I've probably sent out about 50 referrals through this group just since the beginning of the year. So thank you for reaching out and sending them over. It means a lot to me. And we'll see you later. Have a good day, guys.